Jill, I'm going to start with you. What should we expect?
We're thinking maybe it's going to be 1/4 percentage point, and that follows the 1/2 percentage point that we got at the September meeting. It's pretty much what Fed officials have told us in their speeches and in their writings and interviews. So I think that that's the expectation. What happens after that? Well, as the Fed always likes to say, they're data dependent. It really depends as to whether the inflation rate continues to come down and how the job market and the economy hold up.
And Jill, true to your prediction, it is in fact 1/4%, but it was widely expected.
Yeah.
And does the election in any way influence the Fed's decision? Will it maybe for the next Fed meeting?
I don't think that the election has any impact on this meeting. And again, when I said the Fed is data dependent, I'm just sort of throwing their words back at us. In other words, they've got a big job. They want to balance the economy so that the economy is strong enough to grow and create jobs, but not too strong to create inflation. And so right now, the Fed has essentially told us they think they're kind of done on the inflation front. They're going to start lowering interest rates as the inflation rate ticks down to where they'd like it to be. One obvious note that I know everybody feels every day, and that is because the inflation rate is coming down, that does not mean prices are coming down. And I know that stinks. It will get better.
Well, on that note, the economy was the #1 issue for many voters. We have Natalie there at the White House. And again, if you're just tuning in, we have confirmation that the Federal Reserve has decided to cut interest rates by 1/4 percentage point. But Natalie, let's talk about the president-elect and what he is trying to accomplish in terms of his agenda. He has said some things about wanting to try and tie the executive branch to the Fed, which has always maintained his independence. Tell us a little bit more about what we should expect from the Trump administration.
Yeah, well, Lana, the former president and now president-elect Trump ran on the economy, of course, also immigration, but really ran on this promise of bringing down prices, bringing down rates, interest rates. But to Jill's point, the Federal Reserve fiercely guards its independence. And as she also noted, you know, Chair Powell has said that decisions are data-driven, and he believes that the Fed performs best for the U.S. economy when those decisions are independent. But if we look back to the first Trump administration, we saw Trump constantly railing against the Federal Reserve and Chair Powell on Twitter, aggressively pushing him to lower rates. We saw this back and forth. His belief for how the White House should impact monetary policy, the Federal Reserve's decisions, is completely different from how Chair Powell feels. So I think we can continue to see this back and forth. But analysts have pointed out that the economy that Trump is now inheriting is much different than when he entered office in 2017 when it comes to inflation, debt, and other lingering impacts of the COVID-19 pandemic and some of the legislation that came after it.
Absolutely. Such a tremendous change from 2017. And actually, it's worth noting that President-elect Trump actually nominated Fed Chair Jerome Powell, despite sometimes a testy relationship between the two, at least one side in one direction. But Jill, let's talk a little bit more about what this is going to mean for Americans. 1/4 percentage rate cut. It was expected. Many of the banks, when we're talking about like mortgages and things like that, have already taken that into account. So how will this news actually affect Americans?
You know, you're either a saver or a borrower in this economy, right? And so if you're a saver, you hate the cut in interest rates because you know that you'll be earning a little bit less interest on your savings account, your checking, your money markets, your short-term CDs. But if you're a borrower, you are kind of happy. I'm not saying you're going to kick up your heels, but we had a 1/2 point last time, now 1/4 point this time. So if you've got a credit card balance of $10,000 or $20,000,
which a lot of Americans do.
Sure do. And so every little bit is going to improve that. One thing about mortgage rates, the Federal Reserve's short-term interest rates that it controls, it doesn't really impact mortgage rates. Mortgage rates are predicated on the levels of the 10-year Treasury, basically bonds that are IOUs to the U.S. government. I buy a bond, I'm lending the government money, they pay me interest. So that's a market that's based on supply and demand. And You know, the 10-year moves for different reasons, and that's why mortgage rates have not gone down as much as people had thought. Even a few months ago, they thought, oh, we'll get some rate cuts, mortgage rates will go down to 6%. That's not what's happening because there's still this lingering current concern around inflation, a growing economy. And if we start to see inflation tick up a little bit, maybe because there's tariff actions next year, this is really going to keep that 10-year higher for longer. And it's going to hurt potential homeowners because these rates are not moving down below 6% anytime soon.
All right, Jill Schlesinger and Natalie Brand, thank you both.